Climate change doesn't just cause rising sea levels, storms, and wildfires, but it also threatens to derail the US economy and its financial system. I'm Jessica Shankleman, a reporter at Bloomberg News, and I'm joined here today by a formidable panel of experts to talk about a new report that came out last week, which warns that climate change could cause asset prices to be rapidly readjusted and that the shift to a low carbon economy could catch investors off guard, creating huge disruption to markets. Its central recommendation is for a US carbon price, so businesses are paying for their pollution. Perhaps what was most surprising at all about the report is that it exists, given the current political climate. It was commissioned by a special climate subcommittee of the Commodity Futures Trading Commission, which has oversight for the US futures swaps market. Here to talk about it with me today is the CFTC Commissioner Rostin Benham, who sponsored the report, Bob Litterman, founding partner at Kepos Capital, who chairs the risk committee for the CTFC. Also, Mary Schapiro, former chair of the US Securities and Exchange Committee and the CFTC, and she's also currently Bloomberg's vice chair for global public policy, and Nat Bullard, chief content officer for BloombergNEF, who helped write section 2 of the report on the risks to the US of climate change and of shifting to a low carbon economy, as well as the opportunities. Commissioner Benham, let me start with you. What do you expect this to accomplish in terms of regulation, and in what time frame?
Thanks, Jess. This is the first step, I think, for a U.S. regulator and I think a U.S. agency to really start to look and examine these issues carefully and thoughtfully. As you pointed out, there's a direct relationship between climate change and obviously the economy, but underpinning the economy are financial markets. I think most people, if you think about climate change, naturally your mind drifts towards the environment, human health, and of course, energy production. But a huge part of what we're dealing with right now with the pandemic and then obviously the wildfires in the western portion of the United States has to do with the economy. And as we see, and as you pointed out, land prices possibly decrease, insurance risks rise, and migration of people and communities because of these climate risks, we really have to start to think about what it means for financial markets and largely the economy. With that, this report really is groundbreaking in a sense that it's the first of its kind. Very proud of the work that the committee was able to put together, and it's very much in line with the vision that I set out over a year ago. And I'm hopeful at a minimum, much like all other policy, and I think Mary can speak to this, it's building blocks. You have to build a foundation for policy. You have to make an argument. You have to advocate. You have to be able to defend a position. And in the absence of really much policy in this particular space, specifically financial markets and the economy, with a broad group of stakeholders who really represent the entire economy, I'm hopeful that this document will really serve as a starting point for a larger conversation in the U.S. among policymakers, among elected officials, and then most importantly, among stakeholders. Really, that's what we're, my number one responsibility, I think, as a regulator is, of course, to fulfill my duties under the law, but also is to engage with stakeholders and talk to them, see what risks they're facing, and see what I'm doing right and wrong. And when a unanimous group of stakeholders that really, like I said, represents the broad spectrum of the U.S. economy says climate is a risk to financial markets and it will have detrimental effects on the economy for years to come, that's glaring a pretty bright red signal that we have to do something differently.
And given the polarized nature of the debate around climate change in the U.S., how did you get a consensus on this? What consensus did you need to get this written? Was it a unified process?
Well, it was unified, and I'm really proud of that. But ultimately, as a regulator and as a regulator at the CFTC, we focus on derivatives, which is what you pointed out. And derivatives are really about price discovery and risk management for everything from a farmer and rancher to large, global manufacturers who are trying to hedge currency or rate risk. And with that in mind, I can have a conversation with this group about what I think the causes of climate change are. But in my capacity as a financial regulator, what I need to do and what I feel my responsibility is to focus on market risk. We've dealt with market risk back in 2008 with the crisis that was related to subprime mortgages. We're obviously dealing with the risk of a pandemic now, and really the sort of aftershocks of not being prepared for what a health crisis is. And in my view, as we're seeing the climate crisis evolve over decades now and really be amplified in the past few years, unfortunately, this is my sort of call to say, look, we need to start thinking about climate risk as a real challenge for financial markets and something that we need to be better prepared for collectively, both as private sector and public sector market participants. So again, hopeful that this will be the starting point for a larger conversation.
And why do this through the CFTC rather than the SEC? So Mary might also have a view on this as former chair of both.
I would just say, I'd jump in quickly, there was nothing going on. That's just the bottom line. So I stepped in, and I am hopeful that this will be, again, a helpful additive to the conversation. But, second thing is the Commodity Futures Trading Commission is a pretty unique agency. Obviously, a lot of the recommendations, and Mary can speak to this, focus on disclosures and stress testing and under different scenarios. But we, as the CFTC, have a huge constituency from farmers and ranchers to the largest manufacturers, energy providers, mineral miners, you name it, are constituents of the CFTC. And I think it's actually a very nice place to think about this. And the last thing I'll mention is, as a lesson of 2008, financial markets are interconnected, heavily interconnected. And to look at this in silos really doesn't do it justice, because the climate change challenge is global. And to say that this is only within equity markets or only within fixed income or only within derivatives really is not going to solve the problem. Markets are too interconnected. We see that time and again. We see that in the March-April period of this past year when the pandemic really struck us. So we have to think about this comprehensively, and that's why I gave Bob, as chair, really the broadest possible remit to look at this comprehensively.
Mary, do you have anything to add? Or?
Sure. Thank you. I guess a couple of points I would make. First of all, I agree with everything Commissioner has said. I think that physical climate risk really strikes at the heart of the markets the CFTC regulates. So that makes them a very logical agency to do this, but also because of their connectedness to really all financial markets. They were a very logical candidate, and frankly, it took a lot of leadership to step up in this administration and take on such an active role on a topic that's quite controversial here. I would also say that I think the report is substantively a great contribution to understanding the critical role that regulators across the financial spectrum can play in fighting climate change. It's a great policy foundation for the efforts of the bank supervisors, the SEC, the CFTC, insurance regulators, and others. But there's another value I think that the report really brings that's important, and that is that it actually helps show the rest of the world that's far advanced from where we are from a regulatory perspective on these issues. It helps show them that U.S. market participants actually do get it and actually do understand that climate risk presents very significant financial risks with the potential to destabilize the financial system, and that the risks are at the institutional or micro level, the subsystemic level, and the systemic level, and that they're going to play out over the short, the medium, and the long term. And that if we're going to avoid the worst impacts of climate change, it will require ultimately efforts from every sector of our economy and public policy makers and regulators, whether it's with respect to the reduction of greenhouse gas emissions, catalyzing investment in innovative or green products and infrastructure, to Ross's point, improving disclosure around climate risk, which is very much in the SEC's purview, stress testing financial institution resiliency, pricing carbon. All of these things need to happen, and regulators around the world have a really critical role in making sure that they do happen, and that they happen in a time frame that allows us to be successful.
Bob, what do you hope markets will achieve with this? Your central recommendation was for a carbon price, but in the absence of that, what should markets do? Maybe companies setting internal carbon prices, would that be a step forward?
Yeah, Jess, there are a number of steps forward that companies can take and that investors and asset owners need to take. But, you know, this team that put together the report, and they were an incredibly talented and diverse group, all came to the same conclusion, which is that financial markets direct capital in the direction of the incentives that they're given. They're very efficient at doing that. I was a financial engineer for decades on Wall Street, and I know how we can take advantage of every little opportunity and hedge the risks to allow that to happen. Financial markets are incredibly efficient that way, but we have the wrong incentives now. And so right now, capital is flowing in the wrong direction toward the old economy, not toward the new low carbon economy. And so we've got to change that. And the financial markets can't do that on their own. They take those incentives as given and they direct capital in those directions. So what can we do on our own? We can try. Everyone out there is trying to do what they can. They're setting targets and they're planning for the future. But at the end of the day, right now, capital is flowing in the wrong direction. People are making the wrong decisions. They're given the wrong incentives, and emissions globally are increasing. So we have to change this, and the way to change it is to change the incentives. And that's why recommendation. We recognize that it's not the financial regulators, it's not the financial markets that can do this on their own. This is the job of Congress.
Right. So does this report end up in the trash pile if Trump wins?
No, this is a roadmap, and we're going to go down this roadmap. The only question is when. And urgency, you raise a very important topic because we don't have time to waste here. You know, one of the lessons of risk management is that time is a scarce resource. If we have enough time, we can solve almost any problem. And yet, if we don't act quickly, we can make a risk management problem turn into a catastrophe. And you don't have to look far for an example of that. The COVID epidemic is a perfect example where if we had acted a week or two more quickly, we would have reduced the number of deaths, significantly. There was a Columbia University study that estimated the number of deaths could have been cut in half by a 1 week earlier response to that pandemic. Similarly with climate, we don't know how much time we have. We are pushing the Earth's planetary system to a new level of warming, and every year that goes by, that warming increases. We're doing a dangerous experiment. We don't know what's going to happen, but we have to look at the full spectrum of outcomes. You know, in financial markets, we often talk about extreme but plausible scenarios. And that's what we looked at here with respect to climate. And we have to price not only the expected damages, but also the potential for catastrophic damages. That's what risk pricing is all about. Financial markets know how to do it. But at the end of the day, we don't have it now. Again, it's a fatal flaw in the current economic system. When we fix it, it's going to be a phase change in the economy. And all of a sudden, all economic agents who respond to incentives, we all respond to incentives, will be moving in the right direction. Right now, they're moving in the wrong direction. We all get that. We all understand that.
Jess, if I could jump in.
Yeah, please do, Mary.
I just wanted to add that I think having lived through the financial crisis, I can tell you that regulators and policymakers and supervisors can turn on a dime when they're required to do so. And so if we are to get an administration that's more favorably inclined to exploring these issues, I think you can enlist every federal agency to this effort and make a difference very quickly.
I'm quite interested in this.
I gotta jump in. Sorry, one last point about the subcommittee itself, and this addresses your point. But one of the things I was very intentional about informing the subcommittee, and Bob pointed to this, was the diverse nature of the subcommittee, where we have banks, we have institutional investors, we have representatives from energy, agriculture, public interest, the environmental groups, academics, data providers, and exchanges. This builds the foundation, like I said, that really transcends politics. Will it then, of course, make this policy move super quick? Maybe not. But the bottom line is when you have that type of group, when you have that type of diverse coalition, it becomes really hard to debunk as something that's not worthwhile and not something that has to be taken seriously.
Nat, would you like to
Yeah,
chip
I
in?
would just let me
After
just
you,
add
Bob.
that when we first sat down, and Nat will remember this, we talked about what can we agree on. You know, Commissioner said he'd like to see a consensus report. So at our first meeting, we went around the table and started talking about what could we, very little we didn't agree on. Commissioner asked for 50 pages, a high-level summary, and we couldn't limit it to that because we kept digging in and we kept coming to agreement on the need for incentives, on the need for disclosure, on the need for better data and analytics, on all these things, scenarios and stress testing, the need to coordinate with regulators globally and have a coordinated response. All of these things, we just kept digging and we kept agreeing. So we ended up, 3 times the number of pages that the commissioner wanted. But I think it was, a terrific report at the end of the day. Sorry to interrupt, Nat. Go ahead.
Not at all. 100%. I mean, the breadth and depth of what we put together is a feature of the consensus that we came to in so many different areas, in in different endeavors that are impacting across policy and markets. I want to echo Mary's point that markets can move quickly. Absolutely, and that regulators can move quickly to in turn incent what needs to be done. I mean, thinking about this as a playbook for the future, I think is the right way to go. And one of the things that I reflect on looking back on this still is the fact that we began with the carbon price, which I think seems to have this sort of revolutionary tinge here in the United States, but I think of as just the most simple market signal that we could have. I mean, it's actually the way to best unlock markets and let markets do what they do, to Bob's point. It's actually, to me, the point of maximal efficiency in terms of getting things to start happening when you want them to go.
And yeah, the report is absolutely fantastic. It's a really, really good read. Sometimes some of these things can be hard to digest, but it's very powerfully written. Was that part of the idea behind it, to make sure that it was very accessible for anyone to read?
I jump in here, and I know Bob will have a comment, but a lot of these reports are not readable, and there are quite a few of reports that are specifically focused on this exact issue. But I think it was important for me personally, as the individual sort of sponsored and commissioned this, to ensure that anyone could pick this up, understand the issues, really accept sort of the gravity of the situation, and then hopefully be a spokesperson or someone who could advocate for the challenges. And I think even if you just read the introduction and Bob's forward and Nat's pointed to the executive summary and the conclusion, it is moving in the fact that we are facing something that is unique in global history, and that we have to be able to act and react as soon as possible.
And it's available on the CFTC website. Is that right?
That's correct.
Great. I wanted to maybe lighten the mood a little bit. Talking about climate risks is always feels slightly apocalyptic, doesn't it? I think as well as the risks, it also presents some opportunities. Nat, do you want to talk a little bit about how, despite the risks that are presented here, there are potentially sort of opportunities for new companies, new ideas in the low carbon economy?
Absolutely. To begin with, the very basic one that I think Bob should probably expound on is that proper risk management is also a way to generate an outsized return. Like, this is a way to help future-proof portfolios, physical and financial. But secondly, I want to reflect to your point about what readers think. We had a comment from Azim Azhar, who's a writer in the UK, and he said, in reading the executive summary, and I'll give you the exact quote, it contains the future of at least a half dozen great startup ideas. And that's the sort of thing that was an unexpected delight to me, but I also think is extremely important, is that underneath the risk management, or maybe on top of the risk management, I'll let Bob decide that, is a layer of alpha creation, right? Is the response to climate is going to create resilient companies that also are not only better prepared for the future, but are probably also the businesses of the future. And across the spectrum, I mean, stuff within the physical world, a huge amount of attention, and we thought future activity looking at data collection, management, standards, all sorts of things that I think entrepreneurial people will be well positioned to jump in on and make their way with. But Bob, I'd like to hear what you say on that.
Sure, Nat. Thank you. Well, I would point out that the purpose of risk management, many people don't understand that. They think the purpose of risk management is to minimize risk. 25 years ago, when Goldman Sachs asked me to be head of risk management for the firm, they didn't do it because they wanted to minimize risk. They were happy taking risk. They were making money taking risk, and they wanted to make more money. My whole career has been about risk and return trade-offs and optimizing those. And here, with respect to climate, yes, as soon as we get the right incentives, there's going to be incredible opportunities for people to, build new businesses. One way to think about the climate situation that we're in now, and I think, it cuts through some of the complexity, is to recognize that we're probably going to have to take every ton of carbon dioxide that we put into the atmosphere today out of the atmosphere at some point in the future to stabilize the Earth's environment. That's an expensive process. And putting that CO2 into the atmosphere right now is a liability that we're leaving for next generation and the generation after that. This is going to take decades and decades to clean up. So we better get started. And once we get started, there's all kinds of opportunities for new businesses and new activities and cleaning up and strengthening the infrastructure and all of that. I think when we remove the uncertainty about policy, that is going to create an economic boom. So forget about, how it's going to be expensive to the economy. It's actually going to create new jobs. And it's really the removal of the uncertainty about this, which is one reason why we really need a bipartisan effort. This is not a partisan issue. There was frankly no discussion at all about politics on this committee. This is what we have to do. It's a roadmap for the future, and it applies to both political parties. And frankly, it's a global problem that we need to work at globally. Ultimately, we need globally harmonized incentives to reduce emissions. That will be a phase change in the economy, and it's off to the races as soon as we get that done. And by the way, I'm very optimistic. I think we can get that done in a matter of a couple of years. And that, for me, suggests that the financial markets I don't think they expect that. I don't think many people are very optimistic about this. I am, and that to me means it's not priced in. And that, again, is a source of opportunity for investors, asset owners, and so on.
I think it's fair to acknowledge that lots of what's in this report isn't incredibly new. We've seen it before with the TCFD. We've seen it from former Bank of England Governor Mark Carney. Mary, can I ask you, how does this report fit into the worldwide picture? We're already seeing countries in Europe and Asia acting on climate risk. Does this bring the US up to speed?
It certainly helps. Look, climate change, to Bob's point, is a global problem, and it really requires a global solution and a global response. And I think the contribution here, again, is that it acknowledges that we in the U.S. understand across a broad range of financial market participants that we need to do much more in this fight. But if you look at what's happening in the rest of the world, in Europe, in the UK, Australia, New Zealand, Japan, Scandinavian countries, there are multiple initiatives ongoing that demonstrate a real understanding in those countries that there's a critical role for financial regulators to play in the fight against climate change. And it's manifesting itself in all different ways, mandating disclosure. You mentioned TCFD, disclosure of climate risk and opportunity. So there are disclosure mandates arising around the world based on the TCFD framework. We're seeing stress testing of banks for climate resilience, enormous amount of work done by the Network for Greening the Financial System, organization of central banks with over more than 60 members that are stress testing banks' resilience, requiring TCFD type disclosure for their supervised entities, taxonomy development, a definition of fiduciary duty that would encompass considerations of climate change in making investment recommendations. So many things going on around the world. This report pulls them all together and creates, just as others have said, a roadmap for U.S. policymakers and regulators to catch up to the rest of the world and hopefully actually lead going forward.
And next year is the COP26, which is going to be held here in the UK, which is going to be a climate finance COP. How do you think this report will feed into that? What kind of outcomes do you think we might get at that COP from countries on climate finance?
Well, I think we're seeing tremendous focus on COP26, and I think tremendous synergy between this report and a number of the finance work streams that are being developed under COP. So I think, again, this is supportive of everything COP26 hopes to accomplish with respect to finance. And again, it brings the public sector into the discussion as we are on a road to mandatory implementation of things like climate risk disclosure. This report helps to reinforce, I think, those efforts.
Bob, I want to ask you about, we're going back to risk. Sorry, Commissioner Benham, did you want to say something?
Yeah, just to quickly, Jess, 2 points. With respect to the report itself, one thing that I really, really like about the report and the way it's laid out, and you mentioned this earlier in its sort of readability, but the report really starts with the foundations of the issues and then builds towards a number of recommendations in different areas, whether it's disclosures or stress testing, governance, and best practices. But the final chapter is really about green financing, to your point. And one of the really important parts of the report, I think, is how, and Nat I've spoken to this, and Mary just did as well, how we can get the investor community engaged, obviously, more than it already is. It's a huge power in this sort of transition. But I think as regulators and as I think stakeholders alike, we have a responsibility to sort of level the playing field, to provide standard common terms and metrics so that folks can understand what they're investing in and what power their capital has. And just to wrap up, Mary mentioned, a number of the organizations. Obviously, TCFD was a huge part of this, and the findings that they've had, and GFS, the work that Governor Carney did at the bank for a number of years now. I mentioned a lot of this sort of motivation and the inspiration for me making the decision to put this together certainly was a lot of the experience I've had in policy space, both in financial markets and agriculture. But, for the few years I was a commissioner before we started this effort, conversations with all of these individuals and these organizations, and really, put, I think, a premium on me stepping up here and hopefully, as Mary said, putting the U.S. in the right space and heading in the right direction so that we're signaling to the rest of the world that we're here, we're ready, we want to listen, and we want to act.
And to that point, we've got a question from an audience member who's concerned that many investments at the moment are risk blind and will generate millions of US dollars of losses in the near term. So they ask, how can we create policy incentives that allow for the financing of climate change, adaptation, and of resilience building?
I would say from a regulatory perspective, we have to start changing the incentives, right? If you think about the tax code or, some fiscal policy that's been sort of established for decades at this point, we need to change the incentives for folks to allocate capital in different areas that are more green or that will support the transition to a net zero economy in the next few years. So a lot of what we're dealing with, I think, from a fiscal standpoint, the existing fiscal policy and the way the economy has been set up for a number of years, to Bob's point, is really pointed in the wrong direction. So this report, as much as it focuses on financial regulation, you think about the first recommendation, putting a price on carbon, that in of itself would, point the arrow in the right direction and start to really build on a lot of different incentives that I think can flow capital in a better direction.
And of course, we need to have disclosure as a foundational principle about climate risk and opportunities so that markets which are brilliant at pricing risk can do so effectively because they're well informed.
So we're coming towards the end of the...
If I could just add, I think one of the things that we looked at in the committee is, do the regulators have the authorities to oversee these risks? And the answer is clearly they do. But one of the issues is that the climate risks are very different than typical financial risks, in especially the horizon. They go out for decades. and how you think about measuring and monitoring them. We're at an early stage in terms of especially the physical risks, understanding at an asset level what are the exposures, how do those add up to the ownership structures of different companies, and so on. So a lot of work that has to be done, especially in terms of gathering meaningful data and analytical frameworks that will allow us to better measure and manage these risks going forward.
One of the risks I wanted to ask you about, Bob, was the risk of social unrest. We saw in France the Gilets jaunes, the yellow vest protests. How do you bring in new regulations that tackle climate change while also doing it in a just and fair way that keeps the population on side?
Well, you raise a good question, and it's one that we did address as a committee. I co-chair the Climate Leadership Council, which is a sponsor of the Baker-Schultz Carbon Dividend Plan in the United States. And a big part of that plan is focusing on making sure that it is fair, giving all Americans a dividend, which would make 70% of Americans, basically the lower income Americans who use less energy, better off with the dividend than the increase that they would face in energy prices. So there are ways to address fairness and environmental justice, and they have to be addressed. But we want to separate the creation of incentives from the distribution of the revenues that are created by those incentives. And that's why it's up to Congress. We don't write the legislation, but we certainly all agree and recognize that you have to address environmental justice and some of the other major issues, racial, structural, racism in this country, and so on. These are all important issues that we have to address. And the COVID pandemic, in particular, I talked earlier about the lesson from risk management that you have to act quickly. It's also the case that COVID highlights how we're all interdependent. We depend on the actions of others for our own well-being, not just individuals in our households and communities, but also across the country. And frankly, the countries around the world are interdependent as well. And that's why we need a global solution to this problem.
And I also wanted to ask you, Bob, in terms of the US financial market, what's the kind of small, large split? Because lots of the large investors, large banks are already doing quite a lot on climate risk, given that there's action in Europe and Asia. So what would the impact be on, say, like a regional lender in the shale gas patch?
Yeah, we did look at the subsystemic risks, and there are many, and they're both transition risks and physical risks. And so, when you're talking about companies that are in the fossil fuel industry, interestingly, we had several on this committee. There were no significant differences. I was gratified to see that when we sat down and talked about, for example, do we need appropriate incentives to reduce emissions? No one disagreed with that. On the Climate Leadership Council, we have everyone supporting it from ExxonMobil to the World Wildlife Fund, the entire economics profession, all of corporate society, asset owners, investors. We all agree on this. We see the reality of this risk. We recognize that it's not being addressed appropriately, and we're saying it's time to do something. Now, what folks in the financial markets understand that as long as those incentives go in the wrong direction, we're not moving in the right direction. We haven't even started. So this is not a slow evolution toward a low carbon economy. This is change the incentives, get it right, and get started. I call it a slam on the brakes scenario because right now we see the risk, but our foot is still on the accelerator. The incentives are what drive us. And right now they're driving us in the wrong direction. I can't say that enough. Incentives matter. We all know it.
So were there concerns about carbon leakage?
When the subcommittee focused on this, we focused on the financial markets, the risks to the financial markets. We didn't get so much into some of the scientific issues, such as carbon leakage, and I guess you might call that a sustainable finance issue. But obviously, what we need are sustainable policies that will reduce emissions over time. And so, you're not reducing emissions if there's leakage. So we need those, but we didn't get into the details of how you create those incentives and, how you prevent leakage from one country to another or something along those lines. That was beyond the scope of this report.
Great. Well, if I could just finish with you, Commissioner Benham, what's next? You've got this report out. It's had a fantastic response from the environmental community. What's next for you?
Well, it's doing events like this. It's advocacy. It's trying to really raise awareness in the U.S. Across the board, both politically and in the commercial marketplace, so that we can start to take this seriously, more seriously than we are. And I say this often, and it's an unfortunate reality of this effort and the climate change effort. But when I started this, over a year ago, when I started thinking about this many years ago, it's largely driven by climate events that we're experiencing in our country and across the globe. And unfortunately, these climate events continue to happen, and they continue to essentially validate the risks, the issue, the challenges, and the need to take action. And we're seeing that in the States right now, obviously, with the wildfires and hurricane season in the Gulf. So time is of the essence, and we'll continue to talk about this and again, raise awareness and hopefully move the conversation forward so that we can be on a level playing field with our international partners and start to address the issue with clarity and certainty.
Well, thank you so much to all my panelists. And I think that final word, time is of the essence, really resonates with all of us. So thank you to all of you.